Hey traders, welcome back to the channel. Pullbacks can be a game changer when traded correctly, but they can also be tricky if you don't know what to look for. In this video, I'll break down exactly how to spot, confirm, and trade pullbacks with confidence. Let's turn those retracements into your next big profit. Let's get started. Most traders looking at this chart would identify the break above the previous high as confirmation of an uptrend. Next, they'd spot this extreme demand zone as a potential area for buying opportunities. Here's the problem: since this is the higher time frame, it could take hours, or even longer, for the market to pull back and retest this demand zone before executing your buy trades. Now, while some traders don't mind waiting, for most, this long wait can be exhausting and frustrating. This is exactly why mastering pullbacks is so important. If you can transition to a smaller time frame, you'll notice that a pullback is essentially a countertrend move. And here's the exciting part: these countertrends provide short-term selling opportunities as the price moves downward toward the demand zone. By understanding pullbacks, you can capitalize on these shorter-term movements, making profits while still positioning yourself for the bigger, long-term trade setups. But here's the catch: trading pullbacks isn't as simple as it looks. To truly master them, there are three main principles you need to understand. The first principle is how to identify the start of a pullback. Learn to spot the key signs that a pullback is beginning, such as shifts in momentum or breaks in minor structures. These signs are crucial for helping you anticipate the pullback early and time your entry with precision. The second principle is how to trade pullbacks effectively. Master the techniques for entering trades during pullbacks, whether you're using Fibonacci retracements or supply and demand zones. Confirming the pullback's strength and direction is essential to ensure you're entering high-probability setups. The last principle is when to exit a pullback. Exiting at the right time is just as important as entering. Learn to recognize when the pullback is losing momentum or when the market is reversing back in favor of the main trend. Properly timed exits allow you to maximize your profits while reducing risk. Let's go through each principle in detail, starting with the first principle: how to identify the start of a pullback. In this price chart example, it's highly likely that the price will push upward, breaking above the previous high. Once this happens, we anticipate a pullback to retest the demand zone. However, instead of waiting for hours for the pullback to complete, we can look for short-term selling opportunities during this phase. To do this, we first need to identify when the pullback begins by analyzing the lower timeframe structure. Let's switch to a smaller timeframe for a clearer perspective. Here's what you need to understand about the market: after the price breaks above the previous high, it often enters a phase of market exhaustion. This is when buyers start exiting the market, signaling that a pullback is likely. The early signs of a pullback can be seen when the price breaks below the current swing low on the lower time frame. However, it doesn't always happen immediately. Sometimes the price may create a new swing high instead. When this occurs, we need to readjust our analysis and wait for a change in market structure, focusing on the most recent swing low. We continue this process until the price eventually breaks below the swing low, confirming the start of the pullback. At this point, we can begin looking for short-term selling opportunities. It's important to remember that during the exhaustion phase, you should avoid looking for buying opportunities. This is because bullish momentum is significantly weaker, making it less favorable for buy setups. In this example, we see a break below the previous low, which confirms that the market is in a downtrend. This break signals that the price has entered the phase of market exhaustion. During this phase, it's expected that the price will soon pull back to the premium price level before continuing in its original bearish direction. To accurately identify the start of this pullback, we need to analyze the recent market structure. Let's transition to a lower time frame for a clearer perspective. On this lower time frame, the price broke below the previous swing point, establishing this level as our local swing high. A break above this swing high would signal the start of the pullback. However, there are instances, like in this example, where the price continues to push downward, creating a new low. When this happens, we identify the newly formed level as the swing high. A break above this new swing high would then indicate the beginning of the pullback. This process may repeat several times until the price finally breaks above the swing high, confirming the start of the pullback. At this point, we can begin looking for short-term buying opportunities. As I mentioned earlier, during the exhaustion phase, it's crucial to avoid looking for selling opportunities. This is because bearish momentum is weakening, making the market less favorable for selling setups. Instead, focus on positioning yourself for potential buying opportunities when the market structure confirms the pullback. Let's dive into the second principle: How to trade pullbacks effectively. In this example, we can see from the internal structure that there's already been a change in market character, signaling the start of a pullback. To gain a clearer perspective, let's transition to a smaller time frame. The most effective way to trade pullbacks is by utilizing supply and demand zones. In this case, we identify a valid supply zone and patiently wait for the price to pull back into it. Once the price reaches this zone, we execute our sell orders, anticipating a strong move to the downside that aligns with the bearish momentum, ultimately reaching our target. Now, looking at this price chart example, we observe a break below the previous swing low, confirming that the overall market momentum is bearish. However, it's important to note that the market is currently in a phase of exhaustion. To trade the pullback in this scenario, we need to focus on the internal structure. By transitioning to a smaller time frame, we notice multiple breaks below previous lows. This action defines our swing high, and a break above this high would confirm the start of a pullback. At this point, we shift our focus to identifying a valid demand zone. Once the price pulls back and retests this zone, we execute our buy orders, expecting the price to push upward, reaching our target with precision. The final principle is understanding when to exit a pullback. In this example, once the pullback is confirmed, you execute your sell orders at a supply zone with your stop loss placed above it. However, the key challenge now is determining where to set your take profit targets. Many traders struggle with this aspect, which often leads to inconsistent results. Here's the approach. We know that during a pullback, the price tends to retrace toward the discount pricing range, where buyers typically enter the market to push the price higher. To avoid going against this potential bullish momentum, our first take profit target will be at the 50% Fibonacci level. This is a critical level that the price is highly likely to reach, making it a reliable exit point for securing profits. To further maximize profits, we can also set a second take profit target at the 61.8% Fibonacci level. This level often marks the end of the pullback, acting as a potential reversal point. Exiting at this level ensures that we capture as much profit as possible while avoiding unnecessary risk. Anything below this level introduces higher uncertainty and the potential for lost profits. So, for every pullback trade, we establish two take profit targets, the 50% level and the 61.8% level. Price is most likely to move toward and hit both of these targets, making this strategy both practical and effective. From this setup, we use Fibonacci levels to precisely determine our exit points. The 50% level is our safe exit, as there's minimal opposing momentum at this point. The 61.8% level is typically the turning point of the pullback, allowing us to maximize our gains without exposing ourselves to unnecessary risk. Price will most likely push up and reach your target. With this method, you can confidently trade pullbacks while maintaining consistency and profitability. We've now covered the three essential principles you need to master pullbacks. However, before diving into price chart examples, I want to highlight one crucial mistake that many traders make when trading pullbacks. In this example, the overall market momentum is bearish. We've already observed a change in market character in the lower timeframe structure, signaling the start of a pullback. At this point, many traders rush to identify a demand zone and execute their buy orders without recognizing a critical flaw in the setup. If we apply the Fibonacci levels here, it becomes clear that the price has already retested the 50% level before returning to the entry point. This retest signals the likely end of the pullback, meaning the setup is no longer valid. Entering at this stage exposes you to unnecessary risk, as the market is likely to resume its bearish momentum. The key takeaway is this: when the pullback has already reached the 50% level, the opportunity has passed. Stay away from such setups to protect your capital and ensure consistency in your trading. Now that we've covered all the principles and concepts, it's time to look at price chart examples and see how to apply everything together. In this example, we observe that price broke above the previous high, confirming that the overall market momentum is bullish. However, the market has now entered a phase of exhaustion, which will likely be followed by a pullback. To capitalize on the pullback, we need to focus on the internal structure. Transitioning to a lower time frame for better clarity, we see multiple breaks above previous highs, which define this recent low as our swing low. We wait for price to break below this level, as a break below the swing low indicates the start of the pullback. At this point, we identify a supply zone and wait for price to pull back and retest it. Once the price reaches this zone, we execute our sell orders, anticipating the price to drop and reach our target. To determine accurate exit points, we return to the higher time frame and apply the Fibonacci levels. Our first exit point is at the 50% level, which is a safe and reliable target. Our second exit point is the 61.8% level, where the pullback is most likely to end. As you can see in this example, the price successfully reached both take-profit targets, demonstrating the reliability of this strategy. Here's another price chart example. In this case, we see a break above the swing high, confirming that the overall market momentum is bullish. To identify the start of the pullback, we transition to a smaller time frame for a clearer perspective. On this lower time frame, we identify the recent low as our current swing low. We then wait for price to break below this swing low, as such a break would confirm the start of the pullback. Next, we locate a supply zone and wait for the price to pull back and retest this zone. Once the price reaches this point, we execute our sell orders, anticipating that the price will drop and reach our target. To determine precise exit points, we return to the higher time frame and apply the Fibonacci levels. Our first exit point is the 50% level, a reliable and safe target. Our second exit point is the 61.8% level, which marks the likely end of the pullback. As you can see, the price successfully reached both take-profit targets in this example, once again validating the reliability of our strategy. This is our final example. In this scenario, we see a break below the previous low, signaling that the overall market momentum is bearish. The market is now in a phase of exhaustion, which is typically followed by a pullback phase. To capitalize on the pullback, we transition to a smaller time frame for a clearer perspective. On this lower time frame, we identify the recent high as our current swing high. A break above this swing high would confirm the start of the pullback. Next, we locate a demand zone and wait for the price to pull back and retest it. Once the price retests this demand zone, we execute our buy orders, anticipating the price to push up and reach our targets. For precise exit points, we return to the higher time frame and apply the Fibonacci levels. Our first target is the 50% level, while our second target is the 61.8% level. In this example, the price successfully reached our first target but fell short of the second. However, with locked-in profits, we still managed to secure a solid return from this trade. That wraps up today's video on mastering pullbacks. We've covered all the principles, strategies, and examples you need to trade pullbacks effectively and consistently. Remember, the key to success lies in understanding market structure, being patient for the right setups, and managing your risks carefully. If you found value in this video, don't forget to like, share, and subscribe to the channel for more trading insights and strategies. Let me know in the comments which concept you found most useful or if there's a topic you'd like me to cover next. Thank you for watching, and as always, trade smart, stay disciplined, and I'll see you in the next video. Take care.